Hello, investing putts again. Hope you're doing well. Um, it's time for the weekly update. I had a pretty bad week. My portfolio was down 2% while the SPY was up sharply. My problem was that I got called on several stocks, and rather than going back to cash, I decided to roll the covered calls up and out a week. So I took a paper loss, but I still own the shares. So if we may get some upside. The biggest culprit was Intel, which I own a January 2022 leap on. But my covered calls on Dish Network and GDX also expired in the money. The other stocks that I'm long were down pretty heavily, including Walgreens, Schlumberger, and Weight Watchers. I probably, instead of, I probably should have let on Intel and Dish Network and GDX. I probably should have just kept the cash and sat on it, as the implied volatility is very low right now on almost every stock. So I'm not getting much premium for selling covered calls. Here's a list of my current holdings. No changes for the week. I'm long 5 stocks: Dish Networks, GDX, Schlumberger, Walgreens, and Weight Watchers. And I'm selling covered calls on those. I have synthetic long positions on Intel and TLT, which is a Treasury ETF, U.S. Treasuries. I'm trading the poor man's covered call on those because they're pretty expensive. Selling cash secured puts on 4 stocks, 3 stocks actually. First Majestic Silver, Cameco, and Occidental Petroleum. Um, Wells Fargo has earnings, I think, in a week, so I'm going to take a break from selling options and just watch that one. Um, I actually put a call spread on in U.S. Steel when it went way up in price. I was able to buy that back quickly for a decent profit. I also sold a put spread, so for a few days I had an iron condor on U.S. Steel. That stock's been bouncing violently, yet it's stayed in a price channel for several months, so I'm going to keep trading it, as we'll discuss a little bit more in depth. I'm not a day trader or a chart person by any stretch. Still, if you're trying to understand if a stock is overpriced or underpriced relative to its recent historical trend, I think it can be useful to look at a chart. Here's a 6-month chart of U.S. Steel, and I've drawn kind of upper bounds, lower bounds that kind of enclose most of the price action. Um, Stock's been in a general uptrend, but it's been bouncing around pretty violently. It seems to stay in a range a few dollars plus or minus the trend line at any given time. In a week, it can move up 15% or down 15%. So right now, the range is about $20 to $27, which is pretty enormous. Um, when U.S. Steel got around 26, I predicted that it would revert to its trend. So I made a directional bet by selling a call spread for 21 cents. And that was a $27, $29 call spread. I bought that call spread back for 7 cents within 2 days since the stock started dropping. So as the stock dropped, the implied volatility spiked, and I was able to sell a 22.20 bullish put spread for 35 cents. Weight Watchers is another stock that's been in a nice price channel for about 6 months now, though it bounces around pretty violently within that channel, which causes its implied volatility to stay generally high, which is good for option selling. So presently, the stock is sitting just above the low end of the price channel. So, how would I use this kind of technical analysis for actually trading the wheel? So I'm willing to make a directional bet that Weight Watchers is going up in price fairly soon. If I think it's going to go up radically, then rather than selling covered calls and depriving myself of the upside, I should just stay long the stock without selling covered calls when it's down at a low price. So on the other hand, if the stock price is near the top of the price channel, and I think it's going to come down, then rather than selling the usual 30 delta calls, I should be selling much more aggressive covered calls probably at the money or even in the money to collect a bigger premium. And if it goes down, then you still own the stock.